Hi everyone, welcome back to Outspoken Market Global. Leandro Guerri speaking. In this class, I will give you the basics or the introduction about feature engineering, meaning the capability and also the ability to create variables, attributes, features. They are all synonymous for building the inputs, because they are the inputs to your quantitative models. And the main thing I want you already to memorize is without good data, without good features, it doesn't matter the type of model you are using, the technology you're using is the same thing. Garbage in, garbage out. It is a cliche, but yet people don't get this concept. They believe the model is going to do all the work, is going to be the miracle needed in order to have the alpha in the end of the day. But that is not true, and the alpha comes from good data and from feature engineering. And why engineering? Because you will have to understand the subject we are speaking about, we are talking about, that are the financial markets, and then from there start engineering, creating, developing such features. Now, what do we have? In the same channel, we have another couple of classes, one entitled Machine Learning for Trading Workflow, on which I have described to you the whole idea about the process, the workflow for building machine learning models for trading. And then there is a second one on which I explained how I have been building quant models over the past decade. And these two things, they are related to the things we are going to learn today. So I advise maybe you are getting into this channel from this class. So you watch this one first, but please visit the other ones as well. Now, a practical example. Everything starts with the data, of course. But before jumping into the main details about the data, let's just remember that a model, a quantitative model, it's the so-called f of x. It's a function. And that function will receive some data as input, and it will produce an output, usually our estimated y. And such output, in the way I usually teach my students, it is what is the direction of a given asset in the next 5 periods. Commonly, this period it is the daily one, but you can do every 1 hour, every 4 hours, whatever you want. But let's stick with the daily. Everything that I will teach you now, of course, they are principles, so they can be applied to the other time frames as well. Professor, why five, not three, not seven, not one, not 30? Usually, for this set of attributes or features, they work much better with this period. It can work for 30, for 3, for 7, then it's up to you. From my experience, it works much better on that level, on that way. There might be other ways, of course. I'm teaching you what I do and what I know that works, right? That is the first thing that I want you to memorize. Remember, the f of x is going to be our model. And here it could be a neural network, a decision tree, a logistic regression, could be a deep learning model, reinforcement learning model, and so many others. We are not going to worry about the model now, in the future. Now, we want to get some data, transform this data, do some engineering, make them to become the features to our output, that is our target variable or the dependent variable, speaking more on the classical statistical terminology. And this target is the return in percentage in the next 5 periods and the direction. So if in the next 5 periods we have, I don't know, 3%, then it means the direction was up. If we have -2, the direction was down. So the model will get 1 for up, 0 for down, meaning we have a classification problem. Professor, what is a classification problem? Please visit the machine learning for trading workflow and the other class as well, right? So let's focus in the futures in this case. Now, that being said, one may ask, but professor, if I get it right, an up direction, and then I gain 1%, right? And then I got wrong a down direction, and then I lost 2%. Eventually, I got 50-50, but I would be -1. That is true. But what you will also do is implement what we call filters. I'm anticipating an idea because I know some of you are already studying this subject with me for some time, or you are already a little bit more advanced, so you will have this type of question, and it's an intelligent question, but we solve this with filters. And I will stop here. We will have a class specifically about filters. Don't worry about this point. Just please bear with me. Up, down, 1, 0. This is our target, a classification problem, direction. Now, the f of x, that is our model, it's a mathematical approximation of reality. The reality will be our target, as we have seen, that it's our known y. The estimated y is what we will calculate with our model. We need to describe or to make the model to learn what is closer to y as possible in terms of estimation. And this will happen when you give as input the features. Because, for example, I'm trying to build a model that will make a distinction from what it's a chair and what it's a table. Well, I may have features, the number of legs. Well, maybe a chair will have 4, and a table will also have 4. We may have tables with just one, very, very wide and large that will support the whole table. Maybe we'll have a chair that was like an office chair. So we have just one central column, and then you have the support for the wheels, and you have 5 wheels. Then the table will be, of course, with an area much larger than a chair. A chair might be something like, I don't know, 90 square centimeters. Maybe the table will be larger than that. It's going to be maybe 1 square meter in terms of area. The height was going to be different. So all of these elements that I'm describing you now, they are the features that we are going to have. So we will have many rows from chairs and tables, and then we will have many columns describing if it has wheels or not, how many legs, the surface area, and etc. And then your target, that is chair and then table. And then you can say that chair is 1, table is 0. So if you get closer to 1, that object is likely to be a chair. Otherwise, it's likely to be a table. It's how it works. Now, getting it back to our quantitative finance universe, we have, for example, the SPX. We have each row a trading day. So trading day 1, 2, 3, and so on, maybe 5,000 trading days. We have the features, and then the target is in a given day, looking forward, how much was the return, and then we translate this to the up or down. Wow, but professor, you already know that the future return is going to be positive up and down. So you are cheating the model. No, it's a supervised learning. So we need give the machine examples so it can understand the relationship between the features and that particular target. So when you have what we call out of sample data or unseen data on which we don't know, of course, what is the future returns direction, and this is what exactly we want to predict, then we can calculate the f of x, and the f of x is going to tell us, well, there is a 8% probability that in the next 5 periods from that given day that we will have a up direction in the returns for that, right? Great. These are the fundamentals about the relationship we have between models, the f of x, the target, and the attributes. Understand a little bit more about the data. For retail trading, it's indeed quite expensive or complicated to have access to the same type of data that institutional players have. However, this is not an issue. And why this is not an issue? What is the easiest data set that we can have access to? A good broker will give you easily open, high, low, close, volume data, and maybe even some options data if that asset has options. Like, for example, we know the SPX has, the triple Q has, and many others. This is the elementary set of data that a retail can have access without actually paying any money, because many brokers, they already provide that to you for free, or you can download from TradingView library using Python, for example. But I won't get now into the programming side, but just to set the scene. Let's ignore a little bit the options data, and let's start with the basics, that it's open, high, low, and close. Why does it suffice? One may say, Professor, this is a data set everybody has access to. So if there was an alpha, it has been taken already, because market efficiency will have already erased that particular alpha for this data set. Indeed, but it's partially true. Why is it partially true? As I said in previous classes, my theory, and that works, otherwise I would not be here teaching you, is that the market has two possible movements only, right? Or it's trending, or it's reverting to the mean. Everything is inside these couple of things. So you're going up, you're going down, or you're ranging, or you're coming back from the up, or coming back from the down, and you are reverting to the mean. When this type of movement happens, there are always the first ones that are responsible to initiate the movement. There is the mass following it, and there are the laggards. It doesn't matter who is doing the movement, the market always has an inertia, right? And that inertia is a movement will keep happening, or the state will be the same unless there is a contrary force to it that eventually changes, like the law of physics. It's the same stuff in the market. So while you are in there, that movement will keep happening until something else happens. Wow, it's obvious genius. No, it isn't. It isn't. Don't take for granted. It's not obvious. And maybe if it is, the obvious must be said because people forget the basics. People want to do complicated stuff for their egos and they forget that simplicity works. So this is basic market structure or basic movement structures from the market. And this is what we get. So first thing. Second thing, people, they are not disciplined. They don't follow what they build. They follow their emotions. They are herds in the market. Even the institutional, sometimes they are in a herd behavior. So even if you build a model, you will not follow it. So you are leaving your alpha to somebody else. And third, well, you might be clever enough to build something on your own. And oh, I am not a PhD from Harvard, Yale, Oxford, whatever, or triple doctorship in whatever. Yes, great. Those guys are amazing. But you can do something even if you're not one of them. Believe me, you can. It's hard. It's another work. It takes time, but you can. And that is the fourth point. People will give up in the middle of the way. Even if what I'm teaching you now may sound too basic to be true or to work actually in a daily basis, people will give up. Because as you have seen in the previous classes, after you build something, you also need to give maintenance, support, update, and etc. That being said, and these are the fundamentals, the reason because it works. You have the representation of open high, low, and close. If you are speaking about a green candlestick in the chart, so here you're going to have the open, here you're going to have the close, here you have the high, and here you have the lowest point of the day, right? One attribute, or let's call feature one that you can build is, right, the ratio between the high and the low. That feature will give you the day or the intraday, let's say, range volatility. And why the ratio? Because if you're dealing with historical data set, and let's say you get the 5,000 last trading days from a stock that always went up. Here, the stock was 20. Here, the stock was 300 after, I don't know, 10 years, maybe more, almost 20 years. If you have a high and low here, the high and low, if the high was 23 and the low was 21, the movement, the relative movement would be about, let's say 10%. or 2 units. If you have the same 10% here, you would be a range of about, right? If the middle is 300, you may have something like, I don't know, 60 from the idea one. So that was not 10%, it was 5. 5 up, 5 down, approximately. And here, if I would be with 5, then would be 315, just the normalizing stuff. 380, 285, and here I have the same 5%, and then I have my 30. So you see, the difference here was 30, and here was 2. But if you just do high minus low, you will have a serious issue about dimensionality in your model, because the model will be very confused and will not learn anything, because 2 will have the same meaning as 30, and of course is not the same. But if I give the ratio always, all the time, for all variables, then this day, even if it was 20, and this day, even if it was 300, they are comparable. This is one important. Now, a second feature that you will have, right? This distance between the close and the high, or the open and the low, and here we are assuming we have a green candle, but exactly the same rationale, it's valid for any candle direction that we have, candlestick one. This one, it's called the wick, right? So you have high and close, right? You have an F3 that is open and low. You have a feature 4 that is the ratio between high minus close divided, right, by close minus opening. Okay, this is not a ratio, but it doesn't matter because the ratio is here. So I'm getting the proportional or of the wick in relation to the body of the candle. And then you may have a feature 5 that is high minus low divided by the close minus the opening. With just a single candlestick, in this example, you already have 5 features. If you have a minimal, sorry, experience with trading, actually with modeling, you will ask me, Professor, but these attributes, they are extremely correlated. And then if I do any kind of correlation filter, maybe I will be remaining with only one of it. Forget about it. Here we are working with the exception of the rule. I'm not following the same statistical rigor as if I was doing research of a new medicine that eventually, if I get something wrong, I would be, in trouble, because I would be eventually, killing somebody. No, I'm not working on researching a new drug or doing something extremely relevant for healthcare. We're speaking about the financial markets. The financial markets, it's really, really complicated to get anything that is different from tossing a coin. So whatever you have that you get a little bit more than 50%, you are already winning. Assuming, of course, that you have discounted the operational costs and the fees, and that proportion holds. Jim Simon and many other quantitative traders, they had an edge that it's slightly higher than tossing a coin, and they were not worried with this academicism of statistics and things like that. So it doesn't matter. Second point, many machine learning models, they don't care about the correlations and they take care of it during the learning process. So don't worry, just do it. Just create attributes. Just move on. Now, you don't have a single candlestick, right? You have a sequence of candlesticks. And let's say this guy over here was here in a given day. You may have the same features in a rolling window. So you have for that particular day, and then you do the same stuff for a given rolling window. So you have the rolling average of the high-low ratio in a given day, the rolling average of the high and close ratio, and so on. So if you take a rolling window of 10 days and a rolling window of 20 days, so here you have plus 5 features, plus 5 features. So we are already with 15 features. Then you can compare also in a rolling way another feature that is the day. So feature 16, we have the high today in the current candle and the ratio of the low in T minus 5 days ago. And then you repeat it, the same idea, you will be already with 20 features. Then you have the rolling window again, right? The rolling window for the standard deviation of returns and the standard deviation for these guys. So feature 21 plus the rolling standard deviation from all these guys over here. So you are adding already 26 features. And honestly speaking, you can lag all of them. And if I simply lag all of them, what lagging means, right? So if I am analyzing yesterday candle, I will have the 26 features as a snapshot, as a picture of yesterday. Then, what is the influence of the same set of features, but from 5 days before or 3 days before? Because remember, there is the inertia. This is not in the books. If you do that, if you lag, don't worry about dimensionality, don't worry about correlation now. Just create, just do the feature engineering, just throw away all that stuff for a moment and then be free and create it. So if I lag by 3 days, all my 26 features, we will have already 52 features. I think you can already start doing something with that. Did you get the point? My point is, you have all the necessary elements already with you. Really, do you believe, unless you are my student, but I don't have as many students I would like to have, right? So not many people know about it. And of course, I might not be the only one teaching exactly the same stuff, but people, they don't actually know about it. And the ones they know, they are not so many, right? Then there is all the idea of the discipline I told you, and all the other things I told you. You do have an edge if you start building that. Then you can extend this, if the market makes sense, to include the volume. I'm not a fan of the volume, but I know you are, so play around it. It's good for exercising. Adding options data. I am now building models from the idea of the gamma exposure, that we have at least 5 classes about gamma exposure here in the channel. And I have been working lately in developing a model using the PCR, the put call ratio, and it's fantastic. Plus other things that can be derivated out of options data. So you do have a very rich set of data that you can start today playing to build your model. Okay, is that clear? Join the Discord community from the Outspoken. If you have any questions, suggestions, a point that you didn't get, don't hesitate to let me know here in the comment in the community, that I'm more than happy to prepare another class for you. And this is the basics. You can exercising your creativity about in building new features. Start with an Excel. Then later maybe you go to Python, or start already with Python, or take your favorite large language model and drop it there. Whatever, just do it. Okay? So keep things simple. Simplicity works. Trade safe and see you next time. Ciao, ciao.